Auscap is a value manager founded in 2012 by Matthew Parker and myself. We look for businesses that generate lots of cash, and we like to buy those sort of businesses when they're trading materially below what we think they're worth. Auscap was set up with an intention in mind, and that was to create a funds management business that stood for four things: positive performance, strong risk management, which from our perspective is the most critical element of a good fund manager, integrity in everything we do within the market, and last but importantly, a positive culture within the business. The investment team consists of Matthew Parker and myself as the two portfolio managers for the team. We are two of the largest unit holders within the fund, which we think is very important. We don't own any Australian shares outside of our participation in the fund, and importantly, we're invested on exactly the same terms as our unit holders. So there is strong alignment within the business, and we certainly believe that the best way to get an Australian equities exposure is through the fund. Auscap looks for low risk 10 to 15% type opportunities, preferably with some upside, but importantly with limited downside. And our view is that if we can find enough of those type of opportunities that will deliver a 10 to 15% type return on an annualised basis, then our investors should do sufficiently well over time. So we're not looking for the next Facebook or the next Google or the next Fortescue, the next business that starts as a minnow and ends up as a giant company. We're looking for well-established businesses that we think will deliver a sufficiently attractive return to our investors, but with lower than market risk over the duration of the investment. Auscap in many ways is an old school value investor. We're looking for businesses that generate lots of cash, and we want to buy those businesses when they trade well below what we think they're worth. Any company is the present value of its future cash flows, and if we can buy a business well below our estimate of the value of those future cash flows, then we're delighted to look at the company. We also have a quality filter, so we're not looking for any business. We're looking for businesses that we think are of sufficient quality when they're trading at prices that we consider attractive. That's on the long side. On the short side, invert all of those characteristics. We tend to look for businesses that are lower in quality, that are very, very expensive, and that have some sort of catalyst to the downside that will enable us to profit from a depreciation in price. When we look to select stocks for the portfolio, we're focused primarily on two things. The first is the quality of the business. And when we talk about quality of the business, we're talking about its historical return on capital, its cash generation, the balance sheet, whether it's a simple business model, whether it sells products or services that we're inherently familiar with. If it ticks all of those boxes, then the second focus is value, the price that we're paying for that particular asset. And we like to be selective on price, so we're not happy to buy a quality business at any price. We want it to be trading well below what we think it's worth. So that's on the long side. On the short side, we're looking for lower quality businesses that are expensive. So businesses that have low cash generation, often negative cash generation, stretched balance sheets, low return on invested capital, complex or opaque business models, questionable accounting practices, promotional management. If the companies tick a lot of those boxes and they're also expensive, and we can identify a catalyst, most often a declining earnings profile, then we look to select a handful of short positions, largely to protect a lot of the long positions in the event that we get a broad market sell-off. At any given point, the portfolio has between 35 and 45 positions historically, and we are long biased, so we'll have more long positions and more long exposure than short exposure. We'll typically run 20 to 30 long positions and between 5 and 15 short positions. We're index agnostic, so the fund looks nothing like the ASX 200 or the All Ordinaries Accumulation Index. We're cash unconstrained, so if we're not finding compelling investment opportunities, we're happy to sit in cash for long periods of time. We are absolute return focused, so we're looking for opportunities that we find compelling irrespective of what's going on in the market. And by and large, we focus on large and mid-cap stocks. So we tend to be at the bigger end of town, businesses that have been around for some time that we're inherently familiar with. Short selling's been around for as long as markets have existed. It's not a new phenomenon. It appears to be new because we're very focused on it as an industry at the moment. But short selling is trying to profit from a decline in share prices. Why do we engage in short selling? We have a long portfolio that to some extent can suffer from declines if you get a pullback in the broader market, and our shorts to some extent protect the longs from those declines. So while we're trying to make profit on each individual security on the short side, we think collectively they act as a nice hedge for our long exposure. And in a market where there's not obvious headline growth from an economic standpoint, we think the shorts add meaningfully to reducing risk and adding return for the portfolio. Risk management from our perspective is critical, and it starts with security selection. So making sure that you don't overpay for an asset, that you don't buy a business that you don't intend to hold for a long period of time. They're the most critical ingredients to risk management, successful risk management. And then as time passes, making sure that you're devoting most of your attention to the companies and businesses that aren't performing as you expect them to be performing is a critical part of the process. So from our perspective, risk management is spending a lot of time on the existing positions in the fund that aren't behaving as we would expect the businesses to be behaving, and spending a lot of time working out whether that's because we're wrong in our investment thesis, or whether there's a temporary issue that we're happy to sit patiently through, or whether we need to exit because actually what we assumed at the outset has proved to be incorrect. Long-short strategies in general aren't aiming to simply add market beta to a portfolio. From our perspective, we judge the performance of the fund by how we go in declining and sideways markets. Our expectation of ourselves is that during those periods, we will outperform the market. And I don't mean on a 1 day, 1 week, 1 month view, but over any reasonable stretch of time through which you could evaluate a manager. We would expect, conversely, to lag a strongly rising market. In a strongly rising market, our value-based stocks are the last ones that people get excited about. Similarly, we have short positions and they typically detract from performance. But for the mathematically inclined investors out there, they will appreciate that a geometric series is most affected by the size of the negative numbers, not the size of the positive numbers. So we are focused on outperforming most when markets are difficult. And if we can do that and generate attractive returns when markets are doing well, we think the total return for the investor over time should look after itself.